Hello, this is Doug Jones at Mortgage Magic. I want to give you a couple of tips when you buy your house, especially your first house. And the first tip is on taxes. You are not required to take every write-off. I recently had a customer who made a lot of money, but he took a write-off on a thing called a 2106 as a non-reimbursed employee expense. And that expense actually took him out of the opportunity to buy a house. So here's what's interesting. The tax accountant it's their job to save you money. But at the same time, if you want to go apply for a mortgage, you've got to show that you make so much money. So you might want to, 1 year say, look, I need to make this much money, and tell your tax accountant you're going to be buying a house. And then that way, they won't take every little write-off that you don't have to take, because the bank will count that against you. The second thing, buy a car after you buy your house. Buy your expensive, nice car after. We just had a customer, this is March, in February, buy a car, and the car payment is $681. Now what's interesting, that is the only payment she has. However, what it did on the mortgage is it takes the mortgage from the opportunity to buy, she's doing 20% down, to buy a $650,000 house down to a $530,000 house. That's a big difference where we live in Silicon Valley. So two things. One, you don't have to take every tax write-off. Two, buy your car after you get the house, then buy your car. So those are a couple of very good mortgage tips, because I've seen both of these things put people in a little bit of misery. So if you have questions about your mortgage, give me a call. Doug Jones at Mortgage Magic.